All right, let's talk strategy, real estate strategy specifically, because most people think they're investing, but they're kind of stuck in the real estate hamster wheel, flipping houses, chasing rentals, whatever, pad splits, whatever the case may be. But they're kind of spinning the wheels. They're doing a bunch of stuff, but they're really not achieving their ultimate goal, which is financial freedom. So I'm going to break it down in this video step by step, why those strategies don't scale. I'm going to compare different strategies like flipping, the BRRRR method, short-term rentals, co-living, even we're talking about self-storage and mobile home parks, and we're going to grade each one against 6 real-world criteria. So you can finally see kind of which strategies actually work if your goal is to build real wealth and quit your job, but doing so in a more passive way. And the numbers will not lie. I'm a systematic guy. I'm a former software engineer, so you can kind of look at the approach there. So grab your workbook, follow along, and by the end of this video, you'll understand why I believe multifamily isn't just a good strategy. It's actually the easiest path to financial freedom. Let's do this. So the 6 criteria we're going to use is we're going to evaluate, and this is again in your workbook, one of the 10 key points I want you to remember is these 6 criteria. So to what degree does this strategy produce short-term income? How much income do you make in the first 3 months or even at closing by doing a deal? So short-term income. Number 2, what's the cash flow or passive income, right? How much residual income am I getting in that? And then also I want to be able to build wealth. What's the long-term appreciation of whatever I'm doing here? Because ideally, you want to be earning passive income and build wealth at the same time. And then number 4, though, I don't want to work my tail off. How passive is the strategy? How much work do I need to do? And then here's a big one. What's the risk, right? Because what's the risk? And this is very important because you don't want to build some kind of wealth vehicle and then something happens you don't control and then it destroys everything. And then the last one really is what are the tax benefits, right? Because real estate produces great tax benefits, but some strategies are better than others. So we're going to pull all this stuff together and we're going to grade them from a scale of 1 to 5, right? 1 means that the strategy performs poorly in the category and 5 means that it performs very well. So the idea is that the more points a strategy has, the better it's suited for scaling. So I'm coming up with a scaling score. Right? Patented, trademarked right here. So let's look at each strategy and grade it along these 6 criteria. All right. So let's start here with my favorite, flipping houses, right? So as I said before, in a 3-year time span, I flipped over 3 dozen houses. So I have firsthand experience here. So let's talk about each one here. Short-term income. So this is pretty good because it generates chunks of cash. Typically $25,000 to $50,000 per flip and within 6 months. So I'm going to give it a pretty strong 4. Like flips really generate money in like 6 months. I like that. Now, cash flow, well, there is none. So very poor, very low score here. Long-term appreciation, build wealth. Well, you do force appreciation with a flip, but it's really not a wealth builder. So you are building wealth, sort of, but it's not really a wealth builder where you build it while you're sleeping. So I'm going to give this a not that great score. It's not a 1. It doesn't suck. But it's not very strong compared to some of the other strategies. Now let's talk about passive. How passive is it? Well, as we talked about, not very passive at all. It's a boatload of work, so I'm going to give it a very poor number 1. Now let's talk about risk. I'm going to give this a rating of 3, which is okay. Okay. Now, a flip only lasts for about 6 months, so it's less susceptible to market changes, right? And you don't have tenants. So you don't have to deal with the single tenant risk like you do in rentals. We're talking about in a second here. But there are risks, especially if you're using a hard money loan, right? So if your project doesn't sell within 6 months, things start to become, more difficult. You got fees and penalties, and then that can push the project in the red when you have to estimate the ARV, the after repair value correctly, and your construction team has to finish on time and on budget, which are often hard to do in combination. And many flippers find that they end up making less money than they think for one or all of these reasons. So I'll give it a 3 because it's a 6-month kind of flip. And so you don't have the single tenant risk and you don't have the market risk, but you're dealing with a fairly risky project in the scheme of things. But it doesn't suck. Tax benefits is poor, right? Because if you sell the house within a year, which you should, you can't get depreciation. You got to pay a regular short-term capital gain. So this is a very poor tax strategy compared to the other ones. All right, cool. So the overall score is 12. So here's the bottom line. Flips are tough to scale. Most investors, so it has the lowest scaling score out of all of them, as you'll see, which is why I started with them here. Because if the average, most people can handle like 1 flip at a time. One flip takes 6 months. You can do 2 a year. Let's say they generate $50,000 to $100,000 for the year. Not bad, right? But what if I wanted to 10x that? Tough to do with flipping. Plus, it's a lot of work, right? So if you're not buying, we already talked about that. So it's not very passive. All right, okay, we got that one. So let's do a single family rentals, or the BRRRR method. So the most your BRRRR method is you're buy, rehab, rent, refinance, repeat, and it's where you buy a house, you fix it up, find a tenant, refinance it, pull your initial money out, and repeat the process. So let's see how the BRRRR method stacks up. Short-term income, poor. There's no profit when you buy the property, and the only way you can make money is through the rental property, the rental income. So that leads us to cash flow, and it's not that good. It doesn't suck, but it's only, like we talked about, $100, $200 per month. And most people I know with rentals are breaking even or losing money because the cash flow doesn't account for repairs or vacancies. But it does have some amount of passive income, or at least a potential, so it's better than flips for sure. So obviously, this is problematic if you want to earn $10,000 per month, because you need to own a lot of houses to make it happen. Now, what about building wealth? Well, building wealth, I'll give it a good, right? Give it, because you are forcing appreciation when you buy and rent the property, and you're holding it for a little bit, right? The real estate value goes up every year, and let's say you're holding it for 2 or 3 years. So there is some wealth building. You're forcing it, and then you maybe get some market. So it actually does build a little bit of wealth. So I like it okay for that. What about passive? This is pretty good. It's higher than flips, but still not that good. With the BRRRR method, you're still got to fix the house. That's not passive. And once you have a tenant there, you got to become a bit more passive, but it's still difficult. You're still probably going to end up self-managing and dealing with the tenant. And so slightly better than flips, but not by much. The risk is a bit higher than flips, because you have to deal with the 2 other things I talked about earlier, and that is the market risk and the single tenant risk. So market risk is that single family houses are very market dependent. And as you'll see, it's not as recession proof as some of the other strategies. And we saw that in a 2008 recession where single family houses were decimated, right? So I don't love that, but you have this market risk, and houses typically go up and down with the market. You also have the single tenant risk. If your tenant moves out, you're on the hook for the entire mortgage until you can find a new tenant. So I'm giving it a rating of 2, or not that good. Tax benefits. They're better than flips, because if you hold it for more than a year, then at least you get long-term capital gain, which is cool. Also, you do get some benefits from depreciation while you hold the property. Not as much as commercial real estate, as we'll talk about in a second. And so I'm going to give this a 3. So bottom line, the BRRRR method is also difficult to scale, because your money is tied up until you fix it up. You got to fix it up, got to go rent it and refinance. That can take 1, 2, 3 years. And so your money is tied up, so which means that it limits your ability to buy a lot of properties quickly. And even if you have the cash to buy more properties, there's going to be lending limits on residential rentals, right? Most lenders follow the Fannie and Freddie guidelines, and they're going to allow you to 10 properties max. Many local and regional banks still have lower limits, so financing is going to be a bit of a challenge. And then at the end of the day, though, fundamentally, you need a lot of rentals. Right? We already talked about it. You need a lot of rentals to scale this. So I like the BRRRR method. I like it better than flips, because you're at least starting to build passive income. It's less transactional, and you're starting to build some wealth. But it's still hard to scale, because you need a lot of them if you want to replace like a 6-figure income. Cool. All right. Short-term rentals. Oh my gosh. This is a popular strategy that took off certainly in 2020, if not before. And like rentals, there's no short-term income when you buy the properties. This is a rating of 1. There's really nothing up front. Okay, that's fine, because it's a rental property. I get that. Now, cash flow, this is better than long-term rentals. It's not uncommon that the short-term rentals can earn $1,000 or $2,000 per month, which is meaningful. However, having said that, the profitability has really been declining over the past several years as more STR investors enter the market. We talked about this a bit earlier. So your actual cash flow will vary widely based on the market and the type of house you have in that market, but probably still better than long-term rentals if you buy right. So I'm going to give this a pretty good 3. Wealth building, long-term appreciation, I'd say about the same as rentals, because you're holding it for several years, you're increasing the value, you're going to build some wealth there. Passivity is a little better than long-term rentals. I'm giving it a 3 versus a 2, because the income is a bit higher. A lot of STRs are professionally managed because there's higher income, so you can afford to pay a professional manager, which is really cool. Now, it's expensive. They'll charge you 25 to 30% of income, which limits your cash flow, but it's still, from a passivity standpoint, better than both flips and rentals. Risk is about the same as long-term rentals, but I'm rating it slightly lower because of there's still a legislative risk that you don't have with long-term rentals. For example, long-term rentals. It's like, for example, what happened in New York, right? So Airbnb then were outlawed by New York. This happened, I don't know, a while ago. And so now all these investors bought all these condos thinking they can list them on Airbnb, and New York said, no, can't do that anymore, which is surprising, but it shows you it's a relatively new strategy, as in less than 10 years ago, and not every jurisdiction has passed legislation, and some people don't like it. So this, to me, increases the risk quite a bit from the normal single-family long-term rentals, because I don't know what's going to come. And so this, to me, is a little riskier. Tax benefits, I'm going to give this a 3, about the same as long-term rentals. So overall, I like STRs a bit more than long-term rentals because of their higher income potential. But you have to do a lot more work up front to buy in the right market. And the other thing I want to mention, the thing that concerns me about STRs is that it's really becoming oversaturated. I have a friend of mine who 7 years ago got into STRs, and now he's built a substantial STR portfolio. About 3 years ago, he told me that his income was declining, and a couple of years ago, it went into the red. Half his portfolio was in the red, losing money, and so now he's desperately trying to get out of most of his STRs because so many people jumped into it. So that $1,000 to $2,000 per month is a big asterisk. You really got to buy right now. There are some data you can get access to for STRs, but you really got to study that data and make sure that you're somehow insulated from other people jumping into that market. So caution with the STRs on that as well. All right, what do we got next? Co-living, pad splits, right? This includes things like pad splits, sober living homes. And this is a newer strategy where you have a house, and sometimes you have 3 bedrooms, you turn into a 5-bedroom, 5-bath house, and you rent it out by the room. Now, anytime you change a use, I really like it, right? So let's look at this one. Short-term income, it's just like rentals, right? There's no money up front. Cash flow, I would say it's about the same as STRs, because a good pad split in a good market that is operated well can earn $1,000 to $2,000 per month. Again, asterisk, got to be in the right market and things of that nature. Now, building wealth, some wealth building potential is about the same as the other rental strategies. Passivity, I would say about the same as short-term rentals, because for co-living, again, because the income is higher, you can actually outsource the property management. Again, they take a higher percentage of the income, but at least you can outsource it. So I'm saying it's about the same. And then the risk, so to me, it's still pretty high because it's so new that this strategy is still at the mercy of it's still at the mercy of legislative risk because it's so new, right? So be careful where you're going to buy it, because you don't know what laws are going to get passed that could outlaw it. That's also starting to happen, and that's going to be the risk here with the co-living as well. Tax benefits about the same as rental property. All right, cool. Now let's get into other commercial real estate. So this includes things like self-storage, mobile home parks, office, retail, industrial. So short-term income is excellent if you syndicate commercial deal, because you can get paid an acquisition fee, right? So we talked about syndication. You can apply to any large real estate. You can also ground-up development, right? Anything you syndicate. Every time you syndicate something, it's you're putting a deal together. You can get paid an acquisition fee, which means you get paid up front. Cash flow is excellent because it's much higher than the previous single-family house strategy that I just demonstrated with multifamily. And then building wealth is also very high, because just like with multifamily, you can renovate the property, slowly raise rents, and that forces the value of the real estate upwards. And because the real estate is so much bigger, the numbers in absolute terms to you, your partner, and your family are much more significant. Now, passivity, I'm going to give it a 4 higher, but I'm not giving a 5 quite yet, because the passivity depends a bit on the type of commercial real estate you buy. For example, it's relatively easy to hire a good property manager for office, retail, industrial, but it's a bit trickier for mobile home parks and self-storage. So if you study people who are successful in mobile home parks and self-storage, they're almost always self-managing, right? It's much more difficult to outsource that. So just pay attention to that when you consider which asset class you're getting into. Risk is lower than single-family houses because you typically have more than one tenant. So you're not exposed to that single tenant risk. And you also control the value of the property more because it's valued based on the income. So any kind of business, including commercial real estate, is valued on the income it produces. You can have one building producing one income and one producing a higher income. The second building is going to be worth more than the first one, all things being equal, right? Every business is based as a multiple of essentially profits. And so if I can drive up the value of a building, I can actually increase the value of it. I don't need to wait for the market to do that. So with a single family house, two identical houses, one is a primary residence and the other one is a rental property, right? The rental property is not worth more because it's producing income. They're identical because you're still using comps. Does that make sense? So the risk is lower because of that. And again, the risk also depends a bit on the asset class. This is why it's not a 5, but it's a 4, because, for example, self-storage and mobile home parks have been fairly recession resistant, like multifamily over the last several decades. On the other hand, retail got hammered in 2008, and office is still getting hammered because of COVID. So it depends a little bit by the asset class that you're getting into. Tax benefits is excellent, and you get some additional benefits from depreciation. But with commercial real estate, you can get more depreciation sooner by doing something called a cost segregation study, which triggers bonus depreciation or accelerated depreciation. So instead of depreciating a rental property over 27.5 years, you can depreciate about 90% of it in the first 5 years. In fact, right now, the way the tax law is written is 60% can be depreciated in the first year. There's a bill that Trump, of course, I think it's a tax bill being passed right now, that will extend the bonus depreciation to 100% like it was when Trump was first voted into office, which means about your 100% of your investment literally is a tax loss on your K1. So it's the tax benefits of commercial real estate is excellent. All right, the bottom line is this. I do like commercial real estate, and you can see that the scalability score is already much higher than single family house strategies. Again, you can apply syndications to a number of different asset classes. So that we'll end here with multifamily, right? So we're going to go through this pretty quickly here. Short-term income, acquisition fees, very strong. We have cash flow for the same reason. Building wealth, same reason. Passivity is a little higher, and here's why. Because again, the income is higher. I can afford a professional property management company, but there are so many out there. There's actually competition in the market, so they only charge between 3 and 5% of income. And the other thing is, if a property management doesn't work out, there's like 10 others I can find behind it. So what's interesting about multifamily is that outsourcing it to the property manager is already built into the business model. It's very unusual for someone to self-manage anything over 20 units. It might happen in the smaller units, but in 20 and over, it's very rarely happens. It doesn't make any sense. And this is why this asset class I like so much, is because of that fact. It's already built into the asset class. Let's see. Risk, I think, is the best out of all of them. Okay, why is this? First of all, multifamily properties don't suffer from a single tenant risk. If one moves out, you still have 99 other tenants in there, right? It's less susceptible to the market because, like I said earlier, with commercial, I have more control over the value of the building. If the market stays exactly flat, I can still increase the value of the building by increasing the income. It's the most recession-proof asset class. And evidence is how it performed during the Great Recession in 2008, when single-family houses did not perform well at all. Also, it performed well during COVID. For example, office did not. And final evidence is that that's the least risky is the terms you get from lenders. Okay, the terms you get from lenders, you get the highest proceeds and the lowest interest rates out of any asset class. Why would lenders do that? Because in their estimation, the risk is the lowest out of any asset class. Like on our last deal, our interest rate was 5 3/4. And when I looked it up here, single family houses, the mortgage rate is 6.8. Now this may be a little different. Who knows what happened today? So single family house is even higher than a multifamily deal, right? So it's very difficult, it's challenging to get a mobile home park, self-storage you can get for a higher interest rate and lower proceeds, right? And so why is the interest so low? It's because lenders believe that the risk is also lower. And the other reason I believe that the risk is lower is because I like the long-term outlook for multifamily. And so what I mean by that is we're short 3 million housing units. The permits for new apartment buildings are down over 50% over the past 18 months. And so there's no end in sight solving this problem. And this is bad for America, but it is good for people who own rental property. And of course, the reason for that is that you can't build affordable housing because of the cost of construction. And now we got tariffs and immigration stuff. So we got this growing population chasing basically a finite amount of affordable housing. You can't build any more affordable housing. I mean, what I mean by that is anything less than $2,000 in rent, right? And so this is why I believe that the long-term demand is going to fuel the demand for affordable multifamily housing. And that's when I'm going to give it an excellent for the risk and the tax benefits we talked about through cost segregation as well. So this is why commercial real estate really has the highest collective scalability story, multifamily specifically, is in fact the ultimate wealth builder, right? Because there's higher income potential. You get paid up front, during, and at the end. And the numbers are so significant that you can actually quit your job in 1 to 2 years. And the wealth building potential is better. I can implement a value add business plan, increase income, and force appreciation up. Therefore, I'm creating long-term wealth. And it's much more passive. I can outsource this I can buy a property, I can outsource it to a property manager, and then do it again and again. That means I can scale my portfolio without having to work a lot harder. It's also less risky because I'm investing in a recession-proof asset class with continued long-term demand. And that means I have a longer runway to build wealth because you really want to know, you want to build a vehicle that you can drive for a long period of time, right? You don't want to build something for 5 years and then it goes away through some kind of market correction or some legislation that's passed. You want a vehicle that you have time to really build wealth and maybe pass it down to your children. And so this is really why risk is important. And it's also take advantage of many extraordinary tax benefits that allows me to keep more of my profits and build wealth faster. So do you see now why multifamily is the best way to build wealth? All right, so you've seen the numbers, the income, how passive the investment is, the tax benefits. And when you stack it all up, multifamily has the highest scalability score by far. Right. So maybe you're convinced, hopefully I was able to convince you right about, maybe you're thinking, okay, Michael, I get it, but isn't this whole thing kind of an advanced strategy, this whole apartment thing? Don't I need more experience first? And shouldn't I save money first before I get into this stuff? So in this next video, I'm going to show you exactly why that kind of thinking is what held me back for years and how you can shortcut this process with the right team and the right strategy. Now you're going to discover why you don't need years of single family experience and why you don't need your own money to get started either. All this in the next video. Now, if you're already thinking, this is pretty cool, I want to kind of get started, cool training, Michael, but how do I get started now? You're welcome to book a call with my team and talk about what it would like to work with us. All right, so with that, let's get into the next video.